Hello everyone, good afternoon and welcome to the DebtCircle Key Roundup. I'm Vijendra. We begin with an important development in the corporate bond market. Falling government bond yields are making borrowing significantly cheaper for companies. 8 institutions together raised 17,060 crore rupees through bond issuances after the benchmark 10-year government security yield declined by 28 basis points. Most of the fundraising happened in the 3-year maturity segment, with the National Bank for Agriculture and Rural Development, or NABARD, raising 8,000 crore rupees at a coupon of 7.16%, highlighting strong investor demand for medium-term debt.
That's right, Vijendra. The rally in bonds is being supported by multiple positive factors. The Reserve Bank of India's measures on external commercial borrowings and foreign currency non-resident bank deposits, along with expectations that Indian government bonds could soon be included in the Bloomberg Global Aggregate Index, have strengthened investor confidence. As yields fall, bonds become more attractive than many traditional fixed income products, creating fresh opportunities for both issuers and investors, while supporting the continued expansion of India's debt market.
Another major corporate story comes from Tata Steel. The company plans to invest 20,000 crore rupees during financial year 2026 to 2027. Out of this, nearly 12,000 crore rupees will be invested in expanding value-added steel production within India. This investment is backed by the ongoing 5 million tons per annum Kalinganagar expansion project, reflecting Tata Steel's long-term confidence in sectors such as infrastructure, construction, automotive manufacturing, and engineering.
This investment sends a strong message despite global economic uncertainty. By increasing production of value-added steel, Tata Steel aims to improve profitability while strengthening its competitive position against players such as JSW Steel and AMNS India. The expansion is expected to be funded largely through internal accruals, supported by a healthy balance sheet. While global demand and raw material prices remain risks, the long-term outlook continues to benefit from India's infrastructure-led growth strategy.
Let's move to developments in the financial sector. IBL Finance has approved the listing of its outstanding unlisted non-convertible debentures, subject to shareholder approval and the successful listing of its upcoming public NCD issue. The company has also scheduled its 9th annual general meeting for July 31, 2026. Shareholders will be able to participate through video conferencing, while remote electronic voting will be managed by the National Securities Depository Limited, ensuring greater transparency and regulatory compliance.
The listing of these debentures is expected to improve liquidity in the secondary market and provide investors with easier access to tradable fixed income securities. The company will keep its shareholder register closed from July 25th to July 31st, allowing smooth execution of voting and corporate actions. This reflects the broader shift toward digital governance while remaining fully aligned with Securities and Exchange Board of India regulations for listed debt instruments.
Now let's look at the banking sector. Bank of Maharashtra reported strong business growth during the quarter ended June 30, 2026. Total business increased by 19% year-on-year to reach 6,51,000 crore rupees. Global advances surged 27% to 3,06,000 crore rupees, while retail, agriculture and MSME advances grew by 25%. The bank also posted a standalone net profit of 2,014 crore rupees, reflecting a growth of 34.89%, supported by healthy treasury and corporate banking income.
These numbers clearly indicate strong credit demand across multiple sectors. Although the CASA ratio moderated slightly to 49%, overall profitability remained robust, helped by a 12.79% increase in total income. Investors responded positively, with the stock gaining 0.61%, suggesting continued confidence in the bank's ability to deliver sustainable earnings despite increasing competition across the banking industry.
Another significant milestone comes from Arthur Bharat, which has launched Gift City's first physical gold fund. The fund will invest at least 95% of its assets in LBMA standard physical gold bars, securely stored in insured vaults regulated by the International Financial Services Centers Authority. One of its unique features is that investors can choose redemption either in physical gold bars or in cash. The fund also carries a total expense ratio of 0.65% and benefits from advisory support by Singapore-based FinMet, strengthening bullion sourcing and trading expertise.
This launch could significantly deepen activity at the India International Bullion Exchange by encouraging long-term institutional participation instead of purely import-driven trading. Historical data also supports gold's investment appeal. Over the last 10 years, gold has delivered a compound annual growth rate of 13.7% compared with 10.4% for the S&P 500 index. Additionally, gold has maintained a very low correlation of 0.02 with the S&P 500, making it an effective portfolio diversification tool.
The Reserve Bank of India has also taken important regulatory action. It imposed a penalty of 63,60,000 rupees on Bank of Baroda for charging interest above contracted rates and delays in uploading customer Know Your Customer information. GIC Housing Finance was separately fined 3,10,000 rupees for failing to review customer risk categorization every 6 months, as required under KYC regulations. At the same time, Satin Credit Care continued its growth momentum, with assets under management nearing 16,000 crore rupees after first quarter disbursements surged 54% year-on-year. The company also expanded its network by adding 53 new branches, raised 500 crore rupees through non-convertible debentures during June 2026, and reported an 18% increase in net profit during the previous financial year.
These developments underline two important themes shaping India's financial sector. On one hand, the Reserve Bank of India is reinforcing governance, fair lending practices, and stronger compliance standards across banks and housing finance companies. On the other hand, lenders such as Satin Credit Care continue to benefit from rising demand for microfinance and rural credit, supported by expanding branch networks and stronger capital raising. Going forward, investors will closely monitor regulatory developments, funding costs, and asset quality as the sector continues to grow.
Let's now turn to developments in the debt market. Tata Capital is preparing to raise between $300 million and $500 million through bonds maturing in 3 years and 6 months. The proposed issue carries a BBB rating from Standard & Poor's, consistent with the company's previous international bond issuance. Earlier, Tata Capital had successfully raised $400 million at a coupon of 5.3890%, priced at a spread of 92 basis points over comparable United States Treasury securities. The company has also initiated investor calls ahead of the issue, indicating confidence in overseas funding markets.
This reflects a broader trend where Indian non-banking financial companies are increasingly accessing international debt markets to diversify funding sources. Dollar-denominated borrowing provides longer tenure capital and supports both expansion and refinancing requirements. While global interest rates remain an important consideration, continued investor participation indicates confidence in India's financial institutions and the long-term outlook for the country's credit market.
Moving to the banking sector, Punjab National Bank reported a 13% year-on-year increase in credit, reaching 12,75,000 crore rupees during the first quarter of financial year 2020. Deposits increased by 9% to 17,24,000 crore rupees, while total business expanded by 10% to nearly 30 lakh crore rupees. Bank of India delivered even stronger performance, with advances rising 19% to 7,97,000 crore rupees, supported by 20% growth in retail, agriculture, and MSME lending. Deposits also increased 15% to 9,58,000 crore rupees.
These numbers indicate healthy credit demand across retail, agriculture, MSME, and corporate segments. Deposit growth has also remained encouraging, supporting liquidity across the banking system. Strong lending momentum from public sector banks demonstrates continued economic activity, although maintaining a healthy balance between loan growth and deposit mobilization will remain an important focus in the coming quarters.
Another noteworthy trend is the rapid expansion of India's gold loan market. The average gold loan ticket size increased by 39% year-on-year to 1,96,000 rupees during financial year 2025 to 2026, compared with 98,000 rupees in 2023. This growth has largely been driven by a 144% rise in gold prices. The overall gold loan portfolio expanded from 6,30,000 crore rupees to 19,40,000 crore rupees, with gold loans now accounting for 41% of retail credit. States including Uttar Pradesh and West Bengal recorded more than 100% growth in sourcing, while repeat borrowers now account for 75% of customers. Portfolio quality also improved, with delinquencies declining from 0.4% to 0.2%.
The sharp increase in gold prices has encouraged borrowers to unlock greater value from their existing holdings while maintaining relatively low credit risk for lenders. Strong repeat borrowing, faster loan turnover, and improved asset quality indicate that gold loans are increasingly becoming a preferred short-term financing option across both urban and rural India. This trend continues to strengthen the secured lending segment.
Turning to HDFC Bank, the country's largest private sector lender, reported impressive first quarter business growth. Gross advances increased by 15.4% year-on-year to 30,61,000 crore rupees, while advances under management rose 12.4% to 31,27,000 crore rupees. Deposits grew 14.7% to 31,70,000 crore rupees, led by a 17.4% increase in time deposits. The bank's loan-to-deposit ratio stood at 96.6%, reflecting balanced growth in both lending and deposits.
HDFC Bank's performance highlights resilient credit demand despite a competitive banking environment. Higher time deposits indicate that customers continue to prefer fixed income savings amid elevated interest rates, while the bank's reduced securitization activity suggests that more loans are being retained on its balance sheet, further strengthening its long-term earnings profile.
Across the wider banking sector, credit growth has continued to outpace deposit mobilization. The Central Bank of India reported the highest advance growth at 28.8%, while several other banks also delivered strong lending performance. However, slower deposit growth has widened the funding gap, pushing the banking system's loan-to-deposit ratio to 82.7%, one of the highest levels in more than a decade. At the same time, Indian banks sharply reduced short-term certificate of deposit issuance to 708 billion rupees during late June, a decline of 19% from last year, supported by the Reserve Bank of India's measures encouraging foreign currency deposits that could attract more than $50 billion.
Funding strategies are clearly evolving. Foreign currency deposits offering interest rates of up to 7.75% for maturities between 3 and 5 years are proving more economical than short-term certificates of deposit. One-year certificate of deposit rates have already fallen from 7.96% during May to 6.84% in early July, with market participants expecting a further decline of 20 to 25 basis points if liquidity conditions remain favorable.
Foreign portfolio investment trends also remained significant during June. Investors infused a record 41,773 crore rupees into Indian debt markets while withdrawing 49,340 crore rupees from equities, highlighting a preference for fixed income assets amid global uncertainty. Supportive policy measures, including tax benefits for debt investments and expectations of India's inclusion in the Bloomberg Global Aggregate Index, have strengthened demand for bonds. Meanwhile, the Indian rupee closed near 95.21 against the US dollar after declining nearly 1% during the week and is expected to trade between 94.80 and 95.80. The benchmark 10-year government bond yield eased to around 6.71%, marking its sixth consecutive weekly decline, supported by foreign purchases of approximately 346 billion rupees under the fully accessible route.
Overall, today's developments highlight the continued strength of India's debt and banking markets. Falling bond yields, record foreign investment into debt, robust corporate fundraising, expanding bank credit, strong gold loan demand, and improving business performance across major financial institutions all point towards sustained momentum. However, investors will continue to watch global interest rates, Reserve Bank of India policy decisions, currency movements, and progress on India's inclusion in global bond indices. That's all for today's DebtCircle Key Roundup. Thank you for watching.